Well, welcome everyone. My name is Eric Grafstrom. I'm one of the co-founders here at ExitGuide. We're going to start in just a few minutes. Given that it's the top of the hour, we're going to go ahead and give others a few minutes to log in and get their setup going. But want to make note, one, we'll have a recorded version of this. So if you want to go back to it later, we're happy to share that. You'll get that link within the next 24 hours. You'll notice on your in your Zoom app, there is a section to click on if you want to submit a question for us to get to at the end of this webinar. This will last only about 30 minutes. We try to respect your time. And if you're joining us and have not completed one of our free assessments to get a kind of a basic understanding of what your business may be worth, I encourage you to do so. You can do that at exitguide.com. It takes just a few minutes. Okay, everyone. We're going to go ahead and get started. So, good morning and good afternoon to those of you that are joining us. My name is Eric Grafstrom. I'm one of the co-founders here at ExitGuide, and we do monthly we'll call them classes or webinars, but we bring experts like Patrick McMillan, who I'm going to introduce in just a moment here, and want to cover a couple of administrative things at the top of this. So, one, if you have questions, you'll notice on the Zoom app, you'll see a Q&A. Just click that. We'll try to get those questions at the end of the time here. If we don't get to them, we'll provide an email for you to email us. And two, if you've not completed one of our free assessments, you can understand what your business may be worth. I would encourage you to do so. You can do that at exitguide.com. And we do this once a month. So last month we covered, kind of the basics of small business valuations with Brian Walters. And we'll be hosting another one of these in January and February. So keep an eye out for emails from us. So today, pleased to introduce Patrick McMillan. Patrick is joining us from Salt Lake. I'm not going to read this. I'll let Patrick give just a quick summary of his background, but he's one of the experts that we can bring into coaching sessions. So whether you have questions about legal agreements or things like quality of earnings and due diligence or business valuations, we have tremendous people like Patrick who can come in and answer a lot of your questions. So Patrick, welcome.
Thanks, Eric. Appreciate it, guys. Happy to be here. Appreciate y'all taking time to attend it and everything. I'll give you kind of my quick background as to my start and how I got into M&A and everything. So I'm a mountain boy from Northeast Tennessee, Appalachian Mountains, born and raised there. Moved out here to Salt Lake in '06 and have loved the mountains out here. They're very different. So while I was in college, got my start in accounting. Did some time with Citigroup on the accounting side, and then converted over to the finance side. Moved out here to Utah, got picked up by a group of companies who were buying and selling a lot of companies. They were a huge conglomerate. And so spent some time with them started out as their corporate controller and then quickly became the CFO. Grew them quite a bit. And while I was there, I was approached by a lot of our investors and said, hey, we want you to moonlight with us. We've got some other companies that were growing and need your help. So eventually started helping them out from a independent consultant standpoint. And then in 2020 joined at that time what was called Advanced CFO. We have since rebranded to Amplio. So my firm, we started back in '96, about 30 years ago, and now over 140 consultants nationwide. And fractional CFOs. We also have CMOs and HR professionals. We just brought those on this year. My team deals specifically in mergers and acquisitions. Excuse me. So, talking about financial due diligence, we like to say that we are pre, during, and post acquisition. Pre being where we'll dig in, help out, prep, get ready, to buy or sell a company. During being that actual due diligence while you're selling or buying a company, specifically quality of earnings or other types of financial due diligence. And then post being things like purchase price allocation, integration, things like that. So happy to jump in. I love this. This is something that I thoroughly enjoy. I have been involved in, over $2 billion of total transaction value over the last few years anyway. And I don't even know how much worth before that. I never tracked it because it was just something I kind of learned on the job. So a lot of fun. Thank you, Eric.
Great. Well, excited to have you. And so we're just going to jump right into it. I think, let me start a little bit just kind of with some baseline about what ExitGuide does for those of you that are new. We're here to help small business owners. We are not a marketplace. We're not out here actively trying to help you find a buyer. We want to help you actually go from, where do I even start? What are my options for exiting my business? And then moving into, okay, what do I need to do to get prepared? I mean, you see websites that will say, list your business here, let's help you go find a buyer. But for the most part, a lot of small business owners have questions about, okay, can I sell my business? What is it worth? What information would I need to provide to a buyer? How do I even attract a buyer and present my business? And then eventually moving you through that process to actually close the transaction. So we've helped, hundreds, if not thousands of small business owners move through this process, ranging from those that have sold to a competitor, some have sold the asset, some to an employer, others have found buyers on their own. But really, it is starting with kind of the very basics. And so one of the main things that we're going to talk about today is due diligence. And this is just a fundamental part. Over 50% of small business transactions fall apart during due diligence. And a lot of that has to do with, okay, how do you even prepare? What are you even ready for it? It can be actually terrifying for a lot of small business owners when somebody comes and says, yes, I'm actually quite interested, because the question comes, then what? So Patrick's going to walk us through some of the basics, but if you go into your dashboard, you'll notice a couple of things, and we'll show more of this to you in a moment here. But due diligence essentially is when you're ready to share information with that buyer. And you'll see the kind of the buyer portal in the upper navigation bar. And when you click on that, this is what you've completed. And if you want to edit this, you certainly can do so either in here or in your dashboard. And this is the information that you're going to share with that buyer. So when you're ready to go, you can actually just click a button and they'll have access to this information. So, let's just kind of talk about, what is due diligence? I mean, Patrick, I think one of the things that we have learned here is, when you talk mergers and acquisitions, people think of the Wall Street Journal and Bloomberg Business News and, bankers and attorneys. Can you kind of give us just a layman's, explanation of what is due diligence and what does it mean when you're talking about kind of small Main Street businesses?
Yeah, I'll break it down to a very simplistic real world application. So if you've ever bought a house or even a car, there's diligence involved. We'll just use the house example. So you as a buyer, then you have a seller. Sometimes you have a broker, real estate agent, you have a mortgage person, and everybody's doing diligence. You are trying to make sure that that's the house you want to buy. The seller's wanting to make sure that the house is ready to sell. The real estate agents are listing the house and all the stuff about it. Excuse me. The bankers wanting to make sure that it's the proper type of house that they want to finance. That's all diligence. It's the same thing with a business. And whether it's like we're seeing right here, a $457,000 company or a $457 million company, there's diligence involved. It's really that looking into and digging into the nitty-gritty details as much as possible so that the seller's disclosing everything that's necessary for the buyer to understand what they're getting into and to say, yes, this is something I want to transact in and actually buy. Diligence is broken down in several different things. That's something I think we'll be talking about a little bit more higher.
Yeah. And one of the things that we hear is like, do I even need to do this? Especially like if I'm selling this to an employee, a family member, or someone that already knows the business. Do I need to do this? Or maybe my business, hey, it's just not all that complicated. It's not all that, hard to understand the business. Do I really need to do this? And we always tell people yes, but given your expertise, maybe you could explain a little bit more about why this is important, regardless of the size or the complexity or who's buying the business.
Yeah, definitely. And I'm going to talk about, you're going to hear a lot about buy side and sell side. And I know that you're helping a lot of sellers. So I'm going to address this from a buyer standpoint first, so that
Right.
we can
Yeah.
understand the seller standpoint. So a buyer needs to really understand what they're going to buy and how that's going to affect them in their life. And so as a seller, yes, you need to do diligence in order to induce that confidence. Diligence is all about understanding and confidence. And so there are different types of diligence. There's not just financial due diligence, but there's legal diligence. There's customer and vendor diligence. There's what's it called? The seller party diligence. Where they're really looking into, hey, am I gonna keep this owner or founder on for the next 1, 2, 3 years? And if so, what's that relationship going to look like? And so really as sellers, diligence is very important because for a few reasons. Number one, you want to induce that confidence into a buyer that, hey, my company is very solid. It's something that I have grown. Yes, it's my baby, but it's something that I feel like that you're going to be able to take it to the next level. And so you need to help them and to have that confidence in you as a seller, as well as in the company and everything, that marriage is going to work out really well. And it's almost like, I know there's FSBOs, there's a for sale by owners. We're going back to our house example here. If you were just to sell a house by yourself, can you do it? Absolutely. But what happens when you really package that deal with someone who understands and can really talk the lingo of the buyer standpoint? That just really creates so much more appetite and much more confidence in that. It's the same thing with a business. If you're able to package this together and it helps you to understand your metrics as well as the seller, then you can speak with confidence. Hey, now I understand, what my customer unit or my unit economics are, what my customer concentration is, my vendor concentration. Why are my margins? Why did that change? What COVID did to my business, and what's going to happen, now on a go-forward basis? What happens when you put in another dollar of marketing expense? That really helps you to speak with that confidence. And then a buyer's like, wow, you know what? Eric's selling an amazing company. He understands what he's doing. I want to keep him in as a partner, for the next couple of years. And we're going to grow this together. And they're going to pay him a whole lot more money. And there's so many ways you can structure these kinds of deals.
Yeah, and you bring up a good point with the different types of diligence, right? There's legal, there's other. One that we see owners sometimes may be a little surprised when it moves into what's referred to as quality of earnings. And what does that mean? And behind it means kind of really being able to show that once you remove that owner from the business, what's going to happen? And that's an owner dependency thing. So again, kind of as you did with due diligence, kind of a very basic understanding of what that looks like. Talk about quality of earnings, what it means, and owner dependency.
Yeah, definitely. So now this is where I really get geeked out because I'm the quality of earnings guy. It's something that I absolutely am passionate about. I'm going to break the name down for a second to really help everyone to understand what it is. Quality and earnings. So quality, we really help to understand how something is broken down, what it is, what it's doing, whether it's a high, a medium, or a low quality. I mean, you talk about cars, you talk about houses, you talk about food. Everything has a specific quality, and it's all dependent upon the appetite of the individual looking at it. And then earnings. Earnings is what a company is actually bringing down to. You hear bottom line, you hear SDE, seller's discretionary earnings, you hear EBITDA, earnings before interest, taxes, depreciation, amortization. Just funny, I'm here in Utah, and someone pinged me today with a license plate that says EBITDA. We've all seen the pictures of the boat, the yacht that's out there that says EBITDA, but now there's a Utah license plate with EBITDA. So I'm going to find out who that is.
That's great.
Earnings. So earnings comes from various places. So you start top line going down. So Where's the revenue coming from? What's the customer concentration? What does the contract look like? How strong is that contract? Is that really going to continue after a transaction is done? I mean, if there's, if you only have a few clients and the contracts aren't solid, then those earnings really that quality goes low, because who's going to say that that customer is going to stay with that company after the transaction? So those are things you really got to think about. Then you look at the gross margin. Okay, well, let's talk about what are the costs of those revenues? Is it inventory? Is it a service? What's the labor? What's the actual inventory metrics that you're using? And then you move down the line. You talk about all the expenses. What are the salaries utilized? What's the marketing? What's your return on marketing? Things like that. So all that really comes down to your earnings. And then what kind of quality are those? Okay, well, what kind of employees are you using? What are your employee contracts? Where's your building lease? Are you leasing to what's called a related party? In other words, do you own the building in another entity and your company is leasing it from you at a discounted rate, at a non-market rate? And so that's all those things really play into what's the quality of those earnings and how do we normalize that for someone else who's not you as they buy the company. So that's just what a quality of earnings dig into. A lot of people think that a QFE, or quality of earnings, is just about the EBITDA. That's not the case. EBITDA is a portion of it. There's an executive summary that talks about the company itself and how it's grown and why. Then yes, we talk about EBITDA, but we talk about adjustments. How do we normalize those earnings? What kind of adjustments do we need to look at? That's someone that not you is buying the company. But we also look at, well, what's the income statement and why do things fluctuate over time in certain ways? The balance sheet. So many people forget the balance sheet. And that's something that's super important. There's a saying in accounting that you hear sometimes, but not often, but every accrual has to reverse. You have accrued assets and you have accrued liabilities. And I'll just use deferred revenues. If you're taking money from a customer prior to giving them what that product or service is, you have deferred revenue. Eventually, that deferred revenue has to convert from the balance sheet to the income statement. And so there's things like that you have to look at. There again, customer concentration. What percent customer concentration do you have? What about your vendor or your cost of goods, concentration, things like that. So we look at the quality of your earnings in multiple ways. And when we do that for a sell side report, if you're getting ready to sell a company, we do a sell side quality of earnings. That's that report that you give to a buyer that says, hey, look, don't take my word for it. Take Patrick or Amplio's word for it, because that's a third party that I've had come in and really look at my stuff. I get asked a lot, well, how's that different than an audit? It's very different. It feels the same, but the report is very different. An audit will look at the what. What is your company doing that's in compliance with GAAP, generally accepted accounting principles? A quality of earnings looks at the how and the why. How are you doing that? How are you in compliance with GAAP or not? And why? Why do you do it this way? They're principles. They're not rules. They're not things that you have to do specific ways. There's a lot of leverage and leeway in there. And so that quality of earnings talks about those leverages and those leeways. And it really, there again, helps induce that confidence as to how you're doing things and why.
Right. And I love how you kind of separate between the how and the why. So let's talk a little bit about, for those that are joining here or watching this on demand, your dashboard has, steps to follow. And, through that what we like to call a journey, right? You're preparing and you're preparing the narrative and how you position the business and what's the story behind it, preparing your financials. And all of this is to get ready for due diligence. And, I love how Patrick is talking about this from the seller side, because eventually you want that seller to have the confidence that this is a good business to acquire, and they understand what they're getting, why they're buying it at this price. So, there's a couple of different things that you have when you're in due diligence. Maybe Patrick, like what are the fundamentals? Like what's table stakes? If I'm saying, okay, I want to sell my business, in 3 months, what are the things that I need to think about today that I'll need to have ready so that when the seller comes in, I know what questions are going to be asked. I know what information I need to have prepared.
From a financial standpoint, financial due diligence, I'll talk about those first, and I'll talk about kind of some of the outside of financial things. So first of all, financials. At a bare minimum, income statement and balance sheet monthly for at least the past, we'll say 2 years plus TTM. Let me go into that for a sec. 2 financial years. So right now, we're in December. You hopefully have closed out at least your October books, maybe even your November. So the past 2 financial years or fiscal years are going to be January through December of 21 and 22, plus TTM or LTM, trailing 12 month or last 12 month, through that October or November timeframe, because they're really going to dig into that. At least the 2 fiscal years plus TTM, income statement, balance sheet. And then the things that feed into that, if you have inventory, make sure you have some inventory reports by month in there. And I'm talking quantity and I'm talking cost. Okay, so understand what cost you have. If it's a service-based business, understand what types of customer contracts you have and have those in there. You're going to need to have your bank statements because they're going to do what's called a cash to revenue proof and sometimes even a cash to expense proof. So have your bank statements for that time frame available as well and have that ready. Have all these put into your data room and everything. So those are the bare minimums. Things on top of that, customer contracts, vendor contracts, employee contracts, things like that. And then when you get outside of the financial due diligence, you're going to talk about any type of legal issues. If you've been in any even potential legal battles, have some details about that because they're going to ask about those things. There's a whole lot more, but those are at least the basics.
Yeah, no, I appreciate that. So, you've been doing this a while, despite what I like to say, despite the youthful glow of our respective moneymakers here. You've been doing this a while, Patrick. Yeah. Like if you were to just, run into someone that's a friend of a friend at the coffee shop, I mean, what are the do's and don'ts that someone can kind of take away and be like, all right, like, I know I'm going to need to go through this process. What are the things you need to keep in mind? Like, just, you got to do these things, and please make sure you don't make these mistakes outside, of course, of engaging, ExitGuide and professionals like yourself.
Yeah, definitely. And I will reiterate that. Use a professional who understands mergers and acquisitions. And I'm talking about for finance, for legal, and for, those are definitely those primary 2. I've gotten involved with deals where, oh, well, my neighbor or my cousin's mother, or my friend's mom, or or whatever. The thing is you need a professional. Okay, you're gonna save. It's gonna cost you some money up front, but you're gonna save so much more money down the road. So that a lot of don'ts is don't get angry during a transaction. Don't get emotional. I was involved a couple of years ago on a very high-end M&A. We were there were 2 companies that we were merging. One was started in 1978. The other was started in about the early 2000s. And the individual involved in one of those, he was the son of the founder. He was the current CFO and owner. He was not a CFO. He claimed that he was, but he was not. And every time that someone called him out on things, they did it kindly, and he just responded. He was a jerk, and he almost killed the deal so many times. And it finally got to the point to where they stopped inviting him to all the calls. Although he was one of the owners, the other owners just said, you're not allowed to come because you're going to kill this deal. So make sure that you are able to be involved and understand everything from another perspective and respond kindly regardless. Make sure that you know that when you're in a transaction, there's always going to be unexpected things, and there's always going to be more time than what everybody says. I don't care who you are, how long you've done this, how many times you've done this, it's going to take more time. So just be prepared for that.
Great stuff. and we're coming up on our time here. So just a couple of other things. Yes, a little bit of ExitGuide marketing here, but just want to talk about different ways that we can help. So today, some of the screens I've showed you, you have access to a dashboard of tools and resources to start your journey, whether you're again not sure what to do, or maybe you're planning to sell someone or you need to find a buyer. We've got all the tools and resources that are there for you. If you feel like you want a little more help, whether it's with something as simple as just kind of talking through what are the options or the strategy, engaging an expert like Patrick to kind of say, okay, I really need to make sure that I'm ready for a due diligence process and moving through this. That's what a Jumpstart Exit is for. It's working with somebody to help kind of prepare yourself and your business. I can't understand, overstate the value of the emotional aspect of it. Be ready that this is a transaction, and understandable you may have put your heart and soul into this business, but it is a transaction, and you need, oftentimes having somebody that will help you look at this objectively is important. When you're ready to move through the transaction, so you and your buyer have effectively agreed to move ahead and you have a price point in mind, the guided exit will actually help both parties move through the transaction. We're not, at least not today, we're not in the business of helping you go find a buyer. Part of the reason for that, quite frankly, is there's millions of businesses out there all across North America that have different nuances. So our ability to say that we can find a buyer for somebody who, we just, helped a client today out of Dallas that, has a business that sells products for bachelorette parties and helps plan trips and very high-end things. It's an entirely different business than a landscape company in Tacoma, Washington. So when someone says they can help you find that buyer, one, you need to make sure you're ready to engage a buyer in the first place. But two, we're here to help you, when you have that buyer move through the transaction. There's other things that we offer on an a la carte basis. Again, whether it's someone like myself or Patrick or Brian Walters on valuations, we have an array of experts that can, oftentimes early in the process, answer some of the questions. Even if it's 5 steps down the process, a lot of people want to know, well, how am I going to handle this transaction? How do I communicate this to my employees? Can I even sell my business? I want to talk through that. When you're ready to sell the business, a sell sheet really is just a professional way of presenting your business. So yeah, you could email a bunch of people, exactly like Patrick had mentioned. Do you want to just stick the sign in the front yard, or do you want to have a nice glossy brochure that talks about new additions to the house and upgrades to the HVAC unit? So the sell sheet is really intended to help you kind of package this up and get that conversation going, hopefully with more than one buyer. A valuation report is more of presenting your price with a methodology and some data sitting behind it. So if someone comes to you and says, well, why $785,000? You've got something to present to them. A couple of questions that have come in here, Patrick, and also want to assure everybody that we're going to try to get as many of these possible. If not, I'm going to give my contact information at the end of this. So one is, look, what if my financials aren't up to date, but I've got somebody who's interested in the business, whether it's an inbound or someone like, what if these aren't up to date? Like, what do I do?
Yeah, we actually not only get that question, but I see that a lot, and it's okay. You definitely got to make sure that if you feel like you want to sell, go ahead and engage them, but let them know. Be completely honest. Say, hey, listen, I don't feel like my things are up to date. Let me reach out to someone who can help me get those up to date, like myself. And then let's re-engage. Let's at least, be in the chat while I'm reach out to me. There are so many times where I've gotten involved in those, and we'll hurry as fast as we can, but as solidly as we can to get those financials up to date and ready to sell. So at least reach out to that individual, respond to them.
Yeah. And similar to that, you mentioned earlier, this question came in right as you were talking about, the different aspects of due diligence. A lot of people have kind of handshake or verbal agreements with customers or suppliers. What do you do then? I mean, we were meeting with an import-export company out of California this morning, and it had been in business since the late 80s. Everything is on a handshake. Okay, I mean, that's great to have that level of trust and reputation, but when it comes to selling the business, what do you do?
Yeah, at that point, one of the things that I advise is, you know what, let them know, hey, listen, we're trying to really just firm up a lot of our policies and procedures. And so we're creating some contracts now. And so we're going to go ahead and solidify, we're going to memorialize the handshake agreement in the form of a contract. We have agreements to prevent disagreements. And all we're trying to do is create that agreement.
Yeah, I love the way that you put it. And we've got time for one last question. How long does due diligence take? I think I know the answer to this, but you're the expert on in the spotlight today. So how long should it take?
So I'll speak to the essence of a quality of earnings first, and then I'll speak to the essence of the entire thing. So quality of earnings, it's never short enough is the proper answer to that, because it's always, is it ready? Is it ready? Is it ready? 4 to 8 weeks is very typical. Shorter on the shorter end are the smaller, very simple companies, and on the longer end are the larger, more complex companies. The more hair it has, the longer it's going to take. On that same vein is the longer it takes someone to respond to my questions. If you respond to my questions, or whomever it is on my team that's working with you, faster, we can get it cranked out a lot faster. But if you're taking 2, 3, 4 a week to respond, yeah, it's going to take a bit more time. So typical answer, average 6 weeks, 4 to 8 for quality of earnings, financial due diligence. On the entire deal, it's typically 60 to 90 days or 45 to 90. I've seen some get done as short as 30, but pretty typical about 60 to 90 days, for a deal to go from LOI to close.
Great. Well, look, we've covered a lot of ground, and I know those that are participating today or will be watching this on demand probably have questions about their own specific business. And there are a lot of best practices, a lot of standards, but at the same time, every situation has its own unique characteristics. If you have questions, you want to follow up, feel free to email me. It's eric@exitguide.com. If you've not completed your assessment, please do so. That'll get created an account, and you'll have access to not only some of the free tools and resources to start preparing your business for a transaction, but also access to book sessions with experts like Patrick, like Brian, and others who we continue to have as guests. And we hope to hear from you. So, Patrick, any final words before we sign off here?
Yeah, one of those things too is I love jumping in and helping out. So anytime you have questions, love to be a sounding board.
Great. What we got one that came in here. I'm gonna encourage everybody just 2 more minutes. What post due diligence steps should a business owner take to ensure smooth transition for all parties involved? So yeah, you talked about this. What about kind of that post transaction?
That is actually a great question. I'm glad for it. The best thing to do is to make sure that communication is live and involved during the transaction first, because that'll really help ensure a more smooth transition. And then on that same vein, just like we talked about before, make sure that you have everyone involved afterwards. So for financial, make sure you have a good financial partner that's helping you integrate the books and everything. Make sure you have a good legal person involved. That way, because the financial side has to mirror what the legal side has laid out. And then, of course, customers, you as a buyer or seller will be talking with the other party to ensure that transition between customers and everybody, that communication, have a laid out plan that you're going to discuss everything involved, and then have a plan of execution on that. Okay, this is the day we're going to let the customers know. This is the day we're going to let the employees know. This is the day we're going to let the vendors know. Have that plan laid out while you're doing that diligence, and then post-transaction, execute on that plan.
Perfect. Well, look, everyone, I really appreciate your time today. Feel free to reach out. Please, log into your dashboard, try to make good use of this. This saves you steps, in terms of, if you're doing a multi-million-dollar transaction, having somebody like Patrick to kind of tell you what to do and steps to take, we're going to, use our platform to get prepared so you can be efficient with your time and your dollars when you engage someone like Patrick to get into some of the very specific questions that you may not get answered to. Patrick, can't thank you enough. Really appreciate your time today. And again, thanks to all that tuned in or are watching this on demand. And if we can answer any questions, feel free to email me at eric@exitguide.com. Thanks, everyone.
Bye. Thank you.